Gang, we are in the building. Swaggy C is back. I'm telling you guys, 2021 is going to be a crazy year for my YouTube channel and for my academy. On the YouTube part, I am putting out videos all the time, super in detail. I'm not lacking, I'm not BSing, we're here to work. Which brings me to my video today, moving averages. We are going to go over everything you guys need to know about moving averages, what they are, how to trade them, just the most in-depth video I've done about moving averages yet. But before I get into that, remember, right now we have a crazy 3-day sale on the Swag Academy. Everybody knows I launched the Swag Academy last year on February 17th on my birthday. So we have a crazy 3-day sale right now, only 2 days left, for $217. Again, it's the lowest it's ever been, and it's the lowest it probably will ever be, but I'm only doing that because it's my birthday and it's the 1-year anniversary of launching the Swag Academy. And I would have did it on my birthday, but my wife had a lot of things planned for me. You know, I was living with my wife, you know what I'm saying? But we here, we living. If you go to the website right now, www.theswagacademy.com, you will see it. 48 hours left. And you guys are gonna see a very long video right now. So if you guys go to my website, there's old content on there. Go on there, study the old content, engage with the community, be a part of the family. But videos like this, not every video is gonna be 40 minutes, an hour long, but I guarantee you it's going to be as detailed as this, and you're gonna benefit insanely. All right, enough of the website talk. Moving averages. There's so many things you guys need to know about MAs. I think you guys just think if the moving averages are below price and price is just going up, obviously it's an uptrend. And if the moving averages are above price and price is just going down, it's a downtrend. And yeah, that's technically true, but I need you guys to lock in and focus on how to actually implement it on a chart and how to spot it on different time frames. On top of that, I need you guys to really go in depth and learn everything there is to know about moving averages, because I'm tired of, you know, I don't want to say wannabe traders, but wannabe fake traders who come in and learn the bare minimum when it comes to this market, and then they still sit around wondering why they're confused. Now, I'm not saying you have to know every single detail about this market, but it helps to know exactly what you're trading and the reasoning behind it. So without further ado, let's get into the video. So before I get into the actual chart work, I'm going to go over several notes. And for the first 5 to 6 minutes, because this is pretty much going to be a long video, I can pretty much already know, like in 2021, I'm not playing. All my videos don't have to necessarily be an hour long or 40 minutes long, but I want them to be as detailed as possible so nobody has any confusion on what I'm talking about. But the first 5 to 6 minutes are going to be broken down for the absolute beginner. So if you're somebody who has been on my channel or has been studying the market for a long time, you can look at the table of contents and the timestamps below and maybe skip 5-6 minutes ahead and go right to the charts if you prefer. But for those who really want to lock in and feels like it doesn't hurt to learn things over again or learn them in a different way or really learn the reasoning behind certain things, just watch the 5 or 6 minutes. It won't hurt you, and let's start rocking. So I'm about to head to my notes. So again, like I said, the first few minutes are going to be broken down for the absolute beginner, and I'm going to actually go into how to actually calculate a moving average. And again, TradingView does it for you, but it doesn't hurt to understand how they do it. So a moving average is an indicator used to help gauge if the market is going up or down. It's a form of technical analysis. It helps filter out all of the noise from price by giving us the average price over a set period of days. So if I can show myself for a second. So technical analysis, you guys already know what it is. It is, you know, trend lines, it's candlesticks, Fibonacci is a form, and obviously indicators and moving averages are a form. How could I forget psychological levels? That's the biggest technical analysis confluence of them all. Now, with the moving average, price fluctuates so much. It goes up, it goes down, it fakes you out. And what a moving average does is it gives us the average closing period over a set number of days. Now, it's pretty much up to you what number of days you want to measure, whether it's 8, it's 5, it's 10, 15, 20, 50, 200. And later on in the video, I'll go over which ones are most widely used, which ones are used for shorter time frames, and you know, which ones are used for higher time frames. So there are two forms of an indicator, a simple moving average and exponential. They both help smooth out the market. So they both kind of do the exact same thing, but they're slightly different. If I can just show my face for a second, they're a little bit slightly different because simple moving averages is exactly that. It's simple. They take simply the average closing price of, let's say, 5 days. They add them up, up and divide them by the number of days, by 5. So it's just that simple. Exponential places so much weight on recent price action that a lot of traders use it to get in the market earlier because it reacts to the market quicker. Now, I will show you how, EMAs react to the market a lot quicker than SMAs, but I'm just gonna go over a few more things real quick before I give you some examples. So basically what we're saying here is that the moving average is below price, price is gonna head all the way up, it's in an uptrend. And if the moving average is above price, price is gonna head down, it's in a downtrend. Very simple, right? So you can see how they can be beneficial in helping you trade. And for those who are more skilled in the market, give me like 4 more minutes and then I'm gonna get into like using them on a chart and giving clear-cut examples. Now, I'm gonna preface these next 5 minutes by letting you guys know that you don't have to calculate an SMA or an EMA. You don't gotta do the math. They do it all for you. But I just wanna go over it just so you guys can have a peace of mind in knowing what you're actually doing in the market before you do it. So just give me 5 more minutes and I promise you I'll be directly on the charts. So to calculate an SMA, just like I said, you take the average number of closing days and divide it by the number of days. So basically an SMA puts an equal amount of value on all the days you decided to use for that period. So here's an example. So I know like obviously price is more so like 1.35000, but let's just use basic numbers, right? Like 15, 20, 13, whatever the case may be, right? So for a 5-day moving average, let's say we did 5 days, right? And it was 15, right? The last 5 closing days. Let's just say the stock market, for example, 15 plus 20 plus 16 plus 18 plus, I don't know, 14. Right? These are random numbers, but they're 5 numbers, right? You basically just add them all up and divide it by 5. That's how you get an SMA, right? Now, if we add these all up, 15 plus 20 is 35, 35 plus 16 is 51, 51 plus 18 is 69, and 69 plus 14 is 83, right? So 83, right? Divided by 5. Let me just use my phone just to do that. 16.6. So basically they're saying the average closing price of the last 5 days is 16.6. Now obviously take that same math and do the exact same thing for like 1.35, 584, 1.36, 282. I just didn't want to do all the 5 digits right now. That's basically what you do to get an SMA. But 16.6 is the estimate, right? Now to get the calculation for an EMA, it's a little bit different, and it's different because they place more weight on recent price action. So the minute the market reverses, boom, like the EMA is on it, you know what I mean? And to do that, we can't just do basic math like that. So I need you guys to follow very closely for the next 3 to 4 minutes before I go on my actual charts to show you guys moving averages and make it very detailed. And if it sounds confusing, just stop, pause it, and replay it. But again, I'm gonna go through this and then go to my charts. So EMAs start from a previous EMA value. So they don't just take the last 5 closing days and then divide it by 5. They have to start from the previous EMA value. And to get the previous EMA value, we have to actually use an SMA. So reading from my actual notes, since we don't have one, the first value actually comes from an SMA. So if you're using a 10-day EMA, in order to calculate the EMA, get the average closing price for a 10-day SMA, then we utilize that value in our math. So for example, that 16.6 number we just came up with, we are going to use that for a later reference. So remember 16.6. Now, it's quick math with the calculator and TradingView does it for you, but to just keep it in your brain, remember this. Remember I said price is weighted, meaning they put so much emphasis on recent price action. So we have to get that weighted multiplier for the formula. That formula is 2 divided by the number of periods for the moving average. So right now we're using 5, just like we use 5 for the SMA, plus 1. So it's basically 2 divided by 5 plus 1. So basically 2 divided by 6 equals 0.3333. That's the weighted multiplier to calculate a 5-day EMA. If it was a 10-day EMA, we would do 2 divided by 10 plus 1 equals 0.1818. So keep that weighted multiplier, because when we start to utilize these numbers for an EMA, we're going to multiply it by that number. So to get the EMA of where price is over time, we use this formula. The closing price of today, let's say the closing price of the stock market was like 15, or the closing price of AUD USD was like 0.74000, right? The closing price of today minus yesterday's EMA. So if yesterday's EMA was for the stock market like 16, 15, 70, 60, whatever it may be, or for AUD USD 0.73500, 0.73800, whatever it may be, yesterday's EMA times the weighted multiplier plus yesterday's EMA. So let me give you guys an example. So remember we have this 16.6 number right here, right here. So let's just say we're using simple numbers because I know in the Forex market it's like 1.15000, and I'll give you an example like that, but it's a lot easier to just do 16, 15, 20 for this example. Let's just say the closing price of today was like 17, right? So you would do 17 minus 16.6, put parentheses around it, times, since we use a 5-day EMA, remember that weighted multiplier was 0.3333, right? So times 0.3333 plus yesterday's EMA. What is yesterday's EMA? That 16.6 number, 16.6. This helps us calculate the EMA for today, which places so much emphasis on the recent price action. You see how we're focusing on today's EMA, yesterday's EMA. We're not focusing on the entire 5-day period. Like, even though it is a 5-day moving average, what the simple moving average does is it simply just takes the moving average from all 5 days and divides it by 5. It's very simple. So they place an equal amount of value on everything. Even though the EMA has a 5-day moving average, they're really placing emphasis on today's closing price and yesterday's closing price. They're not taking 5 different closing periods. As you see, the formula is today's closing price and yesterday's closing price. We just use that 5 days for the weighted multiplier. So we do this math. Let me get on my phone really quick. So we have our calculator here, and let's just write the problem out so you guys can remember. 17 minus 16.6 times 0.3333 plus 16.6. Let's do it on our phone. 17 minus 16.6 equals 0.4 times 0.3333 equals 0.133 plus 16.6. 16.73 is our EMA for today. 16.7 is the new EMA, right? So another example. Give me 2 more examples and then I'm gonna go right to the charts. Using this same formula, if 16.7 is today's EMA, and let's say the closing price was like 22. 22 minus 16.7 times 0.3333. Sorry, like my iPad is like tilted up, so I can't really write on it, right? Plus the 16.7. We go back to our phone, we delete this, and then after that, I'm gonna give you guys an actual Forex example. It was just a lot easier to use regular numbers for this example. 22 minus 16.7 equals 5.3 times 0.3333 equals 1.76 plus 16.7. The new EMA for today is 18.46. So you see how EMAs are so quick to react to price because all they're doing is focusing on the closing price of today and yesterday. And they just use that 5-day as like a front, but they just use that for the weighted multiplier. They really don't calculate all 5 days, whereas a simple moving average literally places equal value on all 5 days. Let's do a Forex example and let's get right to the charts. So with this, the weighted multiplier is the same, 0.3333, because we're still using a 5-day moving average. If you're using an 8 or a 10, we'd have to use that formula over the 2 divided by the number of days. So right now we're using 5, but that number can switch, plus 1. But let's delete that. I just wanted to remind you guys. So in order to get today's EMA randomly out of nowhere, right? If we're using a 5-day period, we got to get the average 5 days of an SMA first because that starts it all. So let's just say price on GBP AUD closed at 1.35000, right? That's today. And remember, to get today's EMA, we need to calculate the last 5 days of an SMA to start the process off. And then from there, it's just a EMA over. But to start it off, remember, we got to get the average closing price of an SMA first. Since we're using a 5-day EMA, we got to use a 5-day SMA. So let's say the last 5 days was like, I'm gonna take my iPad down so I can actually write on it. 1.34000 plus 1.36000 plus 1.35500 plus 1.35200 plus 1.37000, right? You do that and divide it by 5. I'm just gonna do it on my calculator really quick and give you guys the answer. 6.77200, right? You divide that by 5. 1.35440 is the average closing price of the last 5 days. So that's the SMA, right? Now, deleting this, we will take that number of 1.35440 and put it in this formula, minus 1.35440 times 0.3333 plus 1.35440 440. Remember, the formula is today minus yesterday times the multiplier plus yesterday. Now we can go back to our notes really quick, and then I'm going to get to the charts. 1.35000 minus 1.35440 times 0.3333 plus 1.35440. 1.35000 minus 1.35440. This is the answer, times 0.3333. This is the answer, plus 1.35440. 1.35293. So that would be today's EMA. 1.35293. And then to find tomorrow's EMA, you take that 1.35293 number and put it into the formula, and that 1.35000 number becomes completely irrelevant because you need today's closing price to put that in the formula as well. All right, guys, a lot of numbers. And again, I just want to break it down so you guys knew exactly what you were looking at on TradingView. Again, TradingView does it for you, but I just want you guys to understand what's being calculated when you put a moving average on a chart and not just look at it as, oh, crossover, oh, it's above, it's below. Like, actually understand what a moving average actually is. All right, guys, the moment you guys have been waiting for, actual charts. So with the moving average, again, I got like 2 more minutes for beginners, and then the rest of the video is strictly spot and setups with the moving average and how to actually trade them. So you would go to indicators right here, go to moving average, and click moving average. Now for over here, you can click this, the actual moving average twice, and look at inputs. So right here, this is a 9-day moving average, right? This is a simple moving average too, by the way. So it's just gonna take the last 9 periods and divide them by 9. Now, I'm gonna X this out and give you guys examples of SMAs and EMAs later, but I personally like exponential moving averages only because they put a clear emphasis on what price has done recently as opposed to overall. So I would click moving average exponential, click this, and I use an 8 and a 14 moving average. Again, you guys can use 9 and 15, you guys can use 7 and 13, you guys can use 10 and 20, 20 and 50, doesn't matter. I use an 8 and 14. So an 8, I keep this blue, and then we get the exponential again, moving average exponential, right? Gotta zoom in a little bit. And we get this one, and I make this 14. And these are just 2 of them, right? So this is for crossovers. I make it red. So essentially, anytime the blue crosses over the red, price is in an uptrend. That's basically what the moving average is telling us. And anytime the red crosses over the blue, price is in a downtrend and heading down. That's what the moving averages tell us. To save it, go to templates and click save indicator template, and then you can write whatever you want, like 8 and 14, whatever. I'm not gonna save it because I already have it saved in there, but that's basically what you do. Now, you can use a moving average crossover or just one moving average. There's no like clear-cut difference in my experience and what I've seen in the market. It's just a personal preference. Like, some people like to see the actual crossover of 2 moving averages crossing and intertangling and letting them know that, all right, it's about to head up, it's about to head down. But you can use the same thing on just one. So if I go to my templates and just click 8 EMA, it's the same thing. It's just 1, and whenever price goes above the EMA, it's going up. Whenever price goes below the EMA, it's going down. So it's really a personal preference. Some people like to just see 1 line. Some people like to see 2. So let's get to the 8 and the 14 crossover EMAs, right? So again, right? I don't know why my chart is taking, there we go. I don't know why it's taking so slow. But remember, moving averages are not to be the main confluence. You shouldn't get in a trade just because there's a moving average crossover. Moving averages are meant to be combined with other forms of technical analysis, like a trend line bounce, then a moving average crossover. Bouncing off of support, and then a moving average crossover, you know, a bullish engulfing, and then the blue crosses over the red. It's not meant to be used by itself. So we have it right here, and you can see it clear as day. We have this bounce off of this psychological level, this key area of support right here. Price heads up. This is some sort of a bullish engulfing. Price is a doji, and then it finally gives a Maribozu way above it, breaks above the moving average, and then we get a crossover, blue over the red. What do? That signifies an entry. And mind you, we are on a daily time frame, and I'm only using a daily because it's a lot easier for me to see the overall price to give an example. But honestly, my personal opinion, and like I said, this video is me telling you guys about moving averages, but also giving my personal opinion, and you guys can do what you want with it. You guys can use it and implement it in your own foundation, in your own trading, or you can not use it at all. Or you can take a certain percentage of it and incorporate it in your trading. Whatever it may be, I'm just here to give my opinion, and hopefully it helps you guys. I personally like to look at a moving average crossover on a 4-hour or a daily because it gives me an accurate confirmation on a higher time frame. You may see, if you see a moving average on a 15-minute time frame, It may go up, it may go down, it may go up, it may go down, and you're real susceptible to fake outs. And some scalpers don't care. Like, as long as they see it going up for a good 20, 30, 40 minutes, they're cool. Even some intraders don't care because they may be in the trade for 2 hours. But for me, how I trade, and you guys already know by seeing my psychological levels video and other videos, is I look at the daily and the 4 hour first. I see the overall direction of where the market is gonna go for the next week, the next 2 weeks, whatever the case may be. And then I place my trades based off of that. So if I know price bounced off of a daily support and the outlook looks like it's about to head up another 300, 400 pips. If I go to the 15-minute time frame, I may get in, but guess what? Price may come down and retest it again and stop me out because I have a 10 pip stop loss because I entered on the 15-minute time frame. If I'm looking at a 4 hour time frame, I'm looking at the overall scope of things, right? The daily, 4 hour, overall scope. So I know, okay, it bounced off the support. Let me place my stop loss below it, but my moving average didn't cross over so quickly until it was clearly going up. I need you guys to remember what I just said. On a 4 hour or a daily, look over here. The moving average crossed over and it clearly went up. Even though they had this small retracement, it's still all the way up. And I know for the next week, 2 weeks, 3 weeks, I am trading in the right direction. Not that I'm going to hold it for 3 weeks. I personally like to hold some trades, but for you guys, for the intraday trader, it's good to know where price is going for the next week, 2 weeks, 3 weeks, because you can place your trades in favor of that direction. You can just get out every 2 days, every 3 days. Whenever price starts to retrace, get out, take partial profit, take full profit, get back in, because you know for the next 2 weeks it's going up. And that retracement is just a retracement and not a reversal. I found that some scalpers and intraday traders see that price is retracing, but they think it's a reversal because they're too busy analyzing on a 15-minute time frame. So again, a 15-minute time frame may have gave you a confirmation way down here, and then price may have came back. Let me actually go down to a 15-minute confirmation just to kind of give you guys an example. 15, right? Let's go all the way back over there. Look at this. Clear as day. Price headed up, blew over the red, right? And you thinking about buying and you bought it, and then price just shoots down all the way down. But you predicted price would go way up here. And price shot down all the way down, stopped you out. Now you lost a little bit of confidence, and then price goes exactly in your direction. Same with over here. The moving average crosses up, blew over the red. You decide to get in right here. Price goes up, you're in profit. Price comes down and basically gets you near break even. And now you want to close your trade out because you think price is about to go all the way back down here when it was just retracing and going up the whole time. So like I said, on a daily time frame or 4 hour, we go right back to that area and look at it. Once the moving average crossed over, right here, it crossed over. So yeah, we didn't necessarily get in right here, but when we got in, it was more of a confirmation. And look, it never crosses back over again until it was clearly heading down. Now, I want you guys to remember what I just said. Just because you know the direction for the next 2 or 3 weeks, I like to hold some trades and scale in, scale out, partial profit, full profit. You guys don't have to. But I do think, in my opinion, it is beneficial to look at the overall time frame for the next 2 weeks, 3 weeks, 1 week. And if you know that weekly is going to close as a bullish candle, there's no point in selling during that week if you know the overall candlestick for that weekly time frame is going to head up. But again, you guys can do what you want. You guys can trade how you want. I'm literally just giving my opinion on how I look at the market and how I analyze the market. And you guys can look at it and look at all of it as valuable, half of it is valuable, or hopefully at least 1%. But the goal is for you guys to have your own foundation. But the goal is for me to inspire you guys to create your own foundation on what works for you. Remember, nothing in this market is 100% guaranteed. What works for me may not work for you, and what works for me may work for you. It completely depends on how you back test, how you trade, your risk appetite, your profile, just everything combined. But back to the chart, you see how this caused an entry. So for entries with moving averages, we're looking at a bounce off of support or resistance, or even a breakthrough, but some form of trend. We're looking for a strong candlestick, not small candlesticks. We're looking for strong candlesticks that clearly head up or clearly head down, and then we mix the moving average with it. So right here, we got a bounce, we got a strong candlestick, a break above the moving average, and a crossover. Even on the 8 EMA. It's taking so slow to change over. Hurry up, what's up with this? All right, guys. Bro, you can't be serious. We're busy upgrading TradingView. TradingView is currently down in the middle of my video. I was in my bag. All right, TradingView is back up. Like I was saying, I don't remember where I was at, but I'm just gonna go, right? back to our 8 EMA. You can see it's the exact same thing. We get a bounce off the psychological level, this area of support, right? Price breaks up, strong candlestick, Maribozu, and now price is above the moving average and price is heading up. And remember, moving averages only work during a trending market. What that means is during consolidation, you will see moving average trade in between price. That means there's no trend right now and you shouldn't be in a trade. But when it's clearly below price or clearly above price, price is trending, you should be in a trade or at least looking to get in a trade. Now with the SMA, look how slow it reacts to it. Like this is an EMA, right? So price heads down, red crosses over to blue, price heads up, blue crosses over to red, right? Quick. Look at this 8 and 14 crossover for simple moving average. Look at this. Just look at it for a second while I click it so you can see the difference. Right now, look at this, all jangled. The blue moving average is still over the red and price is heading down. What are you doing? It's too slow to react. And then when the red moving average finally crosses over the blue, price is already up at this point, right? Like it finally crossed over again when price is over here, but with an 8 and a 14 EMA, price crossed over here. And on a 2 hour, 1 hour, 30 minute, you're missing it by a few hours. So for entries, you wanna get the best entry possible. There's no such thing as a perfect entry, but you wanna get the best entry possible. And from my opinion, I think using an EMA works better. Now, I do use longer moving averages for longer term direction. So for example, if I click this 20 and 50 EMA, it tells me from like, for a long time since last May, price has constantly been trading up. Even though we have all of these retracements and price drop down, price has been consistently trading up since May of 2020. I found that a longer term EMA actually works great for direction, whereas a longer term SMA may have some fake outs. And it's weird because a shorter term SMA, from my opinion, in my experience, doesn't really have those fake outs because it's shorter, it's slower to react. It's weird because EMAs are really meant for, you know, shorter term period of days with price. So that weighted multiplier is like 0.3333 for a 5-day or 0.1818 for a 10-day and whatever it may be for a 15-day. But 20 and 50 EMA, like, I don't know what that weighted multiplier will be, but it's giving a good direction of price overall because it's still placing weight on the current day and the last day. It's just using the 20 and 50 for the weighted multiplier. Whereas an actual moving average, a simple moving average, is taking the last 20 days and the last 50 days and dividing it by 20 and 50. And you see how with the, I ain't 14. You see how with the 20 and 50, it's clearly heading up over time. Whereas the 20 and 50 SMA, it crosses over during this period of consolidation. This is consolidation. We shouldn't even be trading this. There's no red over blue. It's just consolidation. So I don't know why the red is over the blue here. It should be close together. But neither here nor there. That's just my experience, and it goes back to my notes. So a potential scenario, EMAs have better entries, and you spot reversals faster, but you're also prone to fake outs. This is for intraday trading and scalpers, right? SMAs, you have slower entries, you spot reversal slower, but less fake outs, which cause you to stay confident in the trade. So it really just depends on your preference. But if you're a scalper or intraday trader, test it out and see what you like better. But when I was an intraday trader, and I'm still an intraday trader to a certain extent, but when I was an intraday trader, I liked EMAs a lot better because SMAs are too slow for entries. Because intraday, I'm only trading for 2 hours. I'm only trading for an hour. I'm only trading for 4 hours. I'm not trading for 4 days or 5 days. Even scalpers, only trading for 30 minutes. So I don't need, slower entries. Now, when it comes to longer term trading, swing trading, or even just looking at the direction of the overall market, I found this scenario to be true for intraday and scalping, but for long-term trading, not necessarily so, because like I just showed you, that 20 and 50 SMA on a longer time frame gave us a crossover of the moving average when it shouldn't have, and the EMA was strictly straight. It was an uptrend, even though price went down. It knew overall that price was still trending up. So look at some screenshots that I have to show you the differences in how quick the EMA reacts to the market as opposed to an SMA. And I sound like a spokesperson for an EMA, but I swear I'm not. I just use EMAs, and this video is, again, it's my opinion. This is my channel, so I'm giving my opinion, but feel free to test it out and see which one you like better. So over here with the EMA, look over here. It's like this area right here, right? Price, look at where price crosses over. The red crossed over the blue right here, right? Now look at that 8 and 14 SMA. Price crosses over right here. That is a big difference, right? For the EMA, price crosses over like right around here. If you look at my cursor, right around here. Whereas the SMA is crossing over right here. Like the red is crossing over the blue, and price already dropped. Like the blue is still over the red, and price already done dropped from 1.34 to 1.29. That is 500 pips you just missed, no matter how you decide to trade it, whether you decide to trade it every day, every few hours, or just hold it for the week, doesn't matter. That's not important. What's important is you're looking at this time frame, the SMA was super slow, whereas the EMA gave you that crossover up here. So you're still effective and still can capitalize on this trade and this drop down here. And it's the same me talking about the fake outs I just talked about with my notes. 20 and 50 EMA, long-term direction. Price consistently heads down. No matter if we have this right here, this retracement, counter trend trading, still red is over the blue. They're telling you, hey, no, price is still heading down in the overall direction. Now, I'm only using a daily to give you guys kind of a quicker review and a quicker example. But if you wanted to use like an hour or 2 hour, just imagine like this price action was on that, right? You can use a trend line for like counter trend trading. And mind you, I'm on the screen. This isn't TradingView. This is me on my screenshot right now from earlier from TradingView. You can use a counter trend, and then when price breaks it, another entry right here, scale in, and then sell, right? Stop loss above the last high. But overall, you know that price is still heading down. And this is a counter trend and not a reversal, because the MAs are still clearly telling you that the red is over the blue. Whereas the 20 and 50 SMA, you will see blue cross over the red and price is still heading down. It's weird like that. So try both out and see which one you guys like the best. Again, I use an 8 and a 14 EMA for entries, to spot the entries and to spot the reversals. But I use a 20 and a 50 EMA for a longer term direction of the market and to see where my key levels are gonna be. Because remember, moving averages don't tell you where your take profit should be. All moving averages do is give you that extra confirmation that price is heading up or heading down. Now for take profit, moving averages don't help with that. What helps with that? Support and resistance, psychological levels. That's how it all comes together. So that's why you can't have the moving averages by itself. You need psychological levels, you know, this support area right here where price stopped at. If I want to go deeper into it, bring it down, another support area, 2 lows right here. So now we have an accurate trend line, right? A potential trend line actually, because a third bounce actually validates the trend line. Just like I said in my other videos, this just shows a potential for a trend line. So now right here, if we're looking at the overall direction of the trend, if I can put my 20 and 50 EMA on, blue is still over the red, right? So that's not an issue. But going back to the 8 and 14 to get another entry, if I wanted to scale in case I was already in a trade right here, or if I wasn't in a trade, I wanted to enter for the first time, I wouldn't just enter off of GP alone, because price can easily still, I don't know why TradingView is taking so slow. They're really doing updates in the middle of my video, which I appreciate, but price can still come all the way down here. Because remember, look at my break of structure videos. Price can still get this low and still trade up, because this is structure, low, higher low. This is still a higher low, even though it popped below the trend line a little bit. So be mindful of that. So what I'm waiting for is that third bounce of the trend line. So when price heads down here, you got to be mindful, because this 8 and the 14 EMA for intraday trading, which is why I have reserved my overall bias to be looking at a longer term EMA and then placing my trades in that direction. When it comes down here, even though the 8 and the 14 may say it's looking down, I know the overall direction is heading up. And I have this trend line that tells me that price is about to head up. So when price goes down and EMA is heading down, that may be a fake out for traders who think price is gonna head down, who can't really identify this trend line, or identify this trend line and think all of a sudden, oh, the red crossed over the blue, it's going to break the trend line and head down. I'm not looking at no break of a trend line until the red crosses over the blue, yes, but until price comes down, breaks this trend line, retests it, and then breaks this low, and then boom, it's at point B right now, and that confirms to me a clear break of a trend line. But if it pops its head below it, that's not a break of a trend line. So when price goes right here, I am now waiting for this bounce, because the bounce is the first confluence. My main confluences that I consider are trend line, support and resistance, and candlestick formations. So a trend line is one of them. So a bounce off a trend line, confluence number 1. Price heads up, and let's say it gives me a bullish engulfing, a morning star, something, confluence number 2. And at that point, the 8 and the 14 will come together and give me my EMA that I need to enter correctly. And that will be the third confluence, and that's your entry. Or for a more conservative approach, because that's kind of aggressive, more conservative approach, now that we have this bounce, Since it's so close to a psychological level, and even though we have this candlestick formation, we would wait because price got here, got here, got here, got here, got here, got here, and it came back down. Granted, it wasn't the third bounce of a trend line. This is the second, which doesn't validate a trend line at all. It's just two connecting swing lows. And this was an actual downtrend, just retesting the level it broke. This is an actual third bounce. So if price wants to head, if I can delete this really quick, right? And price actually heads up, a more conservative approach would be to wait for a price to break above this area and then retest this area, and now it gives you a retest of this support area, which was resistance over here, but it's now support of a psychological level. And now we're looking for price to head all the way up. And how to find a take profit is, first and foremost, for this example in particular, what you always want to remember is that price is so close to the high it made, it made last month. That is a take profit area right there. We don't want to assume that price is just going to break this high. So we always want to make sure we take profit at the high or partial profit at the high. What you could also do is look at the mid-level point between these two areas, right? We'll get a Fibonacci tool here to here. Just to get the 50 point, not to use Fibonacci at all, but just to get the halfway point. Get a horizontal ray, right? And delete the Fibonacci. So now we have our midpoint where we can actually, if we get in right here, we can actually take profit about 100 pips above, because this is a 200 pip range, 1.21485 to 1.23, about 430. So about a 200 pip range, right? This is about 100 pips. So you can take profit 100 pips in or partial profit, so price can like stop, because price may very well do this. Head up, down, up, and then boom, at the high. And then it can even go down again and then break this high. But our initial take profit isn't the high. And remember, the moving average just helps to scale in. So when price comes down and then goes up, now we're looking for that 8 and 14 crossover for extra confirmation for us to get in and ride this trend right here, right? Comes down, comes up again. Now we're looking for that 8 and 14 crossover again for price to come up. The reason we're not looking for it down here and down here is because we know, based off this trend line, based off market structure as a whole, based on everything, based on the 20 and the 50 EMA, and I use the 20 and 50 EMA for a long term. You can use the 50 and 100, 50 and 200. It's all preference, test it out. But back to the point, because I'm in my bag right now and I need to make a point, based on the trend lines, based on the long-term EMAs, based on market structure and price action as a whole, we know that price coming down is mere retracements and not reversals. I need some water because I'm in my bag right now. I'm dropping gems and I'm hoping it is valuable to you guys. I need you guys to see my face right now because I'm really getting to it. I hope this was insanely valuable to you guys. And if it wasn't like 100% valuable, hopefully it was 50%. And if not, even if I just helped you guys 1% by just showing my opinion of the market, that's good enough for me. Remember, nothing is 100% guaranteed in the market. The market can go against you, even back to the charts. Remember, the goal is not to be like 100% calling the market out. Like, the goal is to react to the market. All you can do is speculate. That's what the market is. We are speculating the market. All we can do is use confluences to give us the most confidence possible to predict where price is going to go. But nothing is 100% for sure. All we can do is use confluences to help us gauge our prediction. Now, if I'm predicting price does all it is, and price comes up and stops right here and then comes down, and it breaks structure and takes out this low and starts making lower highs and lower lows after like a retest and then goes lower than the original point it did when it broke the trend line, I'm going to switch my bias and then get in for a sell. And then when I see that next low being made again, like another lower high, I'm waiting for that 8 and the 14 to cross over so the red is over the blue to get me in. And now my take profit levels are what? Psychological levels and the trend line breaks. Point B and point A as my take profits. And then anything lower, I can look at actual psychological levels like 119 and 118. Oh guys, that was such a detailed video. I really hope you guys liked the video. If you feel like you use inmates differently, please let me know, because this is all preference based, this is all opinion based, this is all experience based, and I'm interested to see you guys' experiences and hear you guys' opinions. Overall, if you guys liked the video, please subscribe below and like the video. I work very hard, and all I'm asking is subscribe and like the video. Now, if you do want to see content like this, www.theswagacademy.com. We have a sale the last 2 days, $217 before price goes back to normal. And if you want to take advantage of that, go to the website. Other than that, I will see you guys on the next video. I need some water.